Most notably, the most significant commodity on the planet is crude oil. It's down 9% on the year. There you go. That's a problem. Grains, the most elastic commodities, they start with elasticity. Our blue corn's down, 16% on the year. Soybeans are down, wheat's down. Everything like that's heading down. The number one reason those highly elastic commodities, starting with the grains, are down is because they went up too much to the peak in 2022. It's always the lesson in commodities. Deflation comes from inflation. Commodities go down because they went up. The key thing that's next, the next shoe to drop, is potentially industrial metals. Bloomberg Industrial Metals is basically flat on the year, maybe up 1% to 2%, with the stock market up 8% and the dollar down 8% or so. That's a real bad sign. So I think industrial metals are next potential shoe to drop to follow what I call the 3 C's of commodities: crude oil, corn, and copper. Of those three, two are heading lower. And the last one's copper. It looks like it just put in a pretty good peak. And I think the risk just drops down to some little bit of normal. And I'll just put a number on there. As we speak on August 5th, copper in the US is about $4.40. Typically goes back to $3. The answer to that is yes, because that's one thing I love about markets is the questions can be always the same, but the answers are always different. That's what's really significant. I've enjoyed explaining to that some of my senior managers sometimes when I have differing views from the consensus. And number one, I think it's number one thing to remember in commodities. If your consensus, you're on, you're nothing special. Against consensus is usually a lot worse. For instance, being bearish crude oil when it popped above $40 a barrel. I made that call 3 years ago because it's what always happens. So to me, I'll put in the current context is what's happening right now. We've had the biggest money pump in history. We pumped up everything, most notably commodities, and at the same time, we had the Russians' invasion of Ukraine. That was a perfect storm for an enduring peak in commodities. So far, the high in crude oil has been 130. Right now, we're 65. So it's down almost 50%. The high in corn is around 8. Right now, it's 4, below 4. The high in natural gas is around 10. Right now, it's about 3. And to some extent, copper, it got up there a little bit. I mean, major commodities that trade in a broad-based futures market, which is really my background, trading pits of Chicago. And that is because of deflationary forces kicking in. Number one way to indicate that is let's look at the most significant demand pull source for commodities on the planet. That's China. 1.71 is their current 10-year note yield. And the U.S., the current yield is 4.2%. Severe deflationary forces in China. Ignore what they say, watch what they do. And that's all data can be surveys, but the one thing you can't mess with is a bond yield, especially sovereign bonds. So I see severe deflationary forces, but it's within the context of normal cycles. 2 books, The Price of Time by Edward Chancellor, pointing out all the biggest pumps in history and liquidity always are followed by deflation. That's what deflation is. It's inflated assets, inflated things going back down. It's always on the back of inflation, almost always. And The Price of Time, the great Canadian Jeff Booth. A Price of Tomorrow. Jeff Booth, who pointed out the severe deflationary forces of rapidly advancing technology. I mean, how many photos can I get for free on my phone now? It's just, and so I always tilt over what's happening in the macro. We all know what's happening with electrification. That's part of the reason that at least copper's up 10% on the year and crude oil's down 10% a year. The thing is, copper's so much more macroeconomic, and that macroeconomic tilt is downward. I just look for signs of that changing. So I'll end with what I think is most significant potential deflationary forces just waiting to happen, just a matter of time. And that's the U.S. stock market just having a little bit of normalization. If I'm consensus, I offer no value, and I have to take the risk. Now, you see I've lost my hair of being non-consensus, but also when I have very strong convictions and feelings based on data and history and things I see happening. So I think by the end of the year, we're going to have a down year in the stock market. Right now, it's up 8%. That's the S&P 5 total return. Now, that's a significant shock from consensus. The consensus at the beginning of the year was 10% gain. We had that, and then people added on another 10%. See that part of human nature that happens when you get to the end or near the end of significantly stretched bull markets. To quote my colleague Gina Martin Adams, who's our equity strategist, we've reached a mania stage now in equities. Can't pick a peak, but she said that back in February, March, and we got the 27, almost 20% correction. Now that's the short-term thing. The sharp rally we had was the sharpest ever, but it's the key thing to remember about inflation and deflation. The lessons of there's only 2 times in history, major examples of markets and countries getting more expensive than the U.S. stock market is now versus GDP, versus the rest of the world, versus gold, versus sales. Those are the key things I watch, and that is 1929 in the U.S. and 1989 in Japan. Now I'm somewhat a bit jaded. I started in the business in 1988, working at the Chicago Board of Trade night session. My clients, guess what? At night, we're all Japanese. Been there, done that, seen it. And then I started trading JGBs in the mid-90s, seen that collapse in bond yields, which is the same thing that's happening in China right now. So all lessons of history are deflation comes from inflation. And we have the most elevated stock market in history. And President Trump was elected in 2024. The 2 key things they have in common is U.S. stock market to GDP at over 2x. Now, there's so many other measures. There's always a good reason. It could stay there for longer. When I write my book from the future, am I going to write it was different this time or it wasn't different this time? And that's why I just point out looking for signs. So what I see happening, the key indications are what's happening with gold. You look at gold versus almost all commodities, most notably from my colleague Metals Adams in London, and also another colleague, David Zong, who does models. Virtually every model shows that copper was way overpriced and still is way overpriced versus except one key metric, the U.S. stock market. So I love watching that metric. You take a stock market divided by gold over time. Historically, it's basically 1 ounce of gold is equal to the S&P 500. And just Like in the last year, it was like 2.2 ounces of gold eking the S&P 500. Now that's starting to tilt back downward. I think that's going to continue a lot more than the stock market for good reason. Central banks are buying a significant amount, and ETF outflows for the last 4 years have switched to inflows. So there's a bit of a shift there. But to me, that's where the macro is kicking in, is that, and then also the thing I really love, Tom, is there's a complete consensus that people are piling on the last big trade. The last big trade was that big inflation pump. And every time I hear people buying cryptos, I'm like, oh, we have to help for debasement of currency and inflation. I'm like, sorry, but that's the last big trade. That time to do that trade was 2020, in the beginning of the year, when people like Michael Saylor of Strategy discovered Bitcoin and got a 10x. You put on your spidey senses, rational things, is do I really want to join this highly volatile risk asset when everybody's piling on? And to me, that's the big risk now. The big risk, I think, is by the end of the year, and I'm willing to stop myself out if we're wrong, is that best performing assets will remain gold. I think gold's going to just continue higher and get above 3,500 an ounce, and U.S. Treasury long bonds. And some of the worst performing assets will be the U.S. stock market, led by cryptos heading lower. That's my outlook right now. Copper is part of that downward tilt. It's already started going there. Macroeconomic significant grains, but they're part of that cycle. To me, that's where we're going right now. And the key thing to stop me out in that view is if that's the U.S. stock market keeps going up, and I suspect it's going to go down. So here, I'll end with this. One little trigger. It's August. It's the summer doldrums. It's time of the year where everybody's fine and hanging out on the beach and riding motorcycles and loving it. But the key thing that just happened recently was 30-day volatility on beta, the S&P 500, just dropped to 7.2%. The last time it stayed more than 5 to 10 days below that level was in 2019. So it's a lesson I learned trading options. The Chicago Board of Trade is volatility is always mean reverting. When it gets that low, and then there's things, I'll point out one more thing. I think one thing the gold market loves, absolutely loves, is President Trump pushing back on the Fed, pushing back on any data from U.S. government he doesn't like. Gold says, thank you very much, we'll buy more. Anything that if you buy, you can lose it's maybe as much as you paid for. For instance, the riskiest assets, I think, right now that are top of the radar are cryptocurrencies. Bitcoin is number one, but now there's 19 million. It was number one in 2009, and now there's 19 million. Just a simple lessons of supply and demand says, yeah, that's a problem, way too much supply. Let's look at a risk-off asset. Gold is considered a store value risk-off asset. Yes, it does fluctuate, but there's gold, and then there's 3 other difference, 19 million cryptocurrencies, unlimited supply, 3 precious metals, limited supply. Okay, I get that. I'm still sticking with that. But to me, the number one measure of risk assets on the planet is S&P 500. It's beta for the planet. I worked at S&P 500. Where's the index? I worked at a hedge fund. We use S&P minis as our measure for all risk. It's beta. If S&P 500 drops 10%, the whole world goes down. If it goes up 10%, man, that's what it always does. I mean, that's the key thing that matters. So that to me is what's going to be a matter. If it's 20% down and leverage 5 to 1, buy a home. If your home drops 20 or 30% and you're highly leveraged, that can be considered a risk asset. But basically, it's things that we invest our money in. Number one typically is the stock market. Now, risk off assets, the number one risk off asset in the stock market asset on the planet is U.S. Treasury T-bills, supposedly the safest assets on the planet. I say that supposedly because it's been pushed back a little bit. And my lessons, every lesson I've learned having traded treasuries since I first started, and rates are going to go up because of excess of supply. That's usually been a time that points out yields are going to go down. So to me, this is the next big trade. Is one thing I'll point out. So gold has been one of the biggest trades the last few years now. It's been outperforming the stock market for almost 5 years. It's been actually the same. Gold is that it's always kind of had a decent correlation with, treasury long bonds. I mean, if you look at the longest of long bond, it's 30 years, and even the longest is a 30-year zero coupon bond, where you just buy that bond at a discount and it goes back to par over time. So right now, the key thing I point out about gold is it's been the risk off asset. People are using it for store value and for safety. It's the most expensive ever by some measures. I guess going back 50 years versus that US T-bond. I said that 2 years ago. Darn, I've been wrong. Hopefully it's in my lifetime. I think it's going to start this year. Hopefully I think it's going to start this year. Well, people have heard it before. Honest, ancient, yes, I've been wrong, but I pointed out better assets. I certainly was a much more advocate of Bitcoin for the last 5 years, certainly 19 and then 20 specifically. But lately I've been really scared, pointing out for the last almost 5 years, how gold's beating stocks. The rock beats stocks. That's a bad sign. So far this year, stock market's about 8%. Just imagine the iteration. And if we stay here, that's fine. If we keep going higher in the stock market, that's wonderful. That's what's priced in. It's the optionality of the next big trade that I expect to keep in, and that is the stock market starts giving back those gains as the U.S. heads for that recession that we didn't get 2 years ago, but for really good reason. Tariffs. What's the number one thing that these tariffs are going to do is going to hit corporate profits. So the number one thing tariffs are doing, first of all, is pressuring the whole rest of the world. The vast majority of it, who's for the last 50 years, has become over-dependent on net exports to the U.S. A thing I learned when I worked in a trading place, and I got my MBA at night, and of course in the MBA you learn all those academic things. Oh, free trade's great, and that's what we all need to do, free trade. Then I remember getting on the phones. I was always on the phones with clients, a lot of them in London. They'd say, yeah, everybody in the world wants free trade as long as they can run net exports with the U.S. And that turned out to be the fact, and that's true. That's what Mr. Trump is cutting off. And you're seeing that what's happening in the rest of the world. Now, U.S., and I just will be publishing by the time this comes out, pointing out that collapse in the imports of U.S. goods is as certain as death and taxes. It's going to continue to collapse. So that's not so much an indication for the U.S. We'll see what that means. I'll get to that in a second. But it means what's happening to the rest of the world. You've seen that's what happened in China. They're getting shut off, so they're trying to find export markets, and they have to. The whole rest of the world is pushing back a little bit on massively cheap exports from China. The one little story that came out recently, there was a story in the New York Times about Indonesian exporters getting hammered and people losing their jobs and having to find, I grew up in the Midwest. I kind of grew up with that. I remember people losing their manufacturing jobs, and it's happening. There was another article on the Bloomberg Terminal recently about the wine industry in France and might be losing a billion euros the next year or two and lose 600,000 jobs. Like, again, I'm sorry, but for I don't know how many years, France charged 20% wine on U.S. imports into France, and U.S. charged near zero. Well, sorry, but that's been cut off, kibosh. You could say thank you, but that's again, But guy from the Midwest, I grew up hearing that and seeing that with people who, I was kind of grew up in a blue collar town, who predatory exports from China and the rest of the world, taking away some of these U.S. businesses. Now that's being turned around. So you're seeing the whole world's going to be pressured. That's going to kick in industrial metals, which I think just on the cusp of breaking down. It's going to, and it's just a matter of time to hurt corporate profits. So right now, corporations are eating some of that. It's going to pressure that inflation in the short term. But remember, this is back to the U.S. 2/3 of U.S. economy is services. What we saw today as we speak on August 5th is the U.S. Service Employment Index just dropped to the lowest level in 4 years. So they're not hiring people. That's a problem. Corporate profits. The number one reason, if you own a plant in the U.S. of any type of manufacturing in the heartland, and you did the absolutely politically incorrect thing to shut down that plant and put people out of work who sometimes you went to high school with, the only reason you would do that is because you had to do that for survival to keep your corporate profits up. Boom, that's being shut off. And that's what to me is going to happen. We're going to hurt corporate profits. But the key thing to stop the stock market is only one thing, Tom. It has to stop going up and go down. When you get to this point, it's a frenzy mode. Very akin to, like I pointed at, 1929 in the US, 1989 in Japan. It's things I remember in 1999 and 2007. And we start going down. That's happened a little bit. We've had a lot of earnings beat. The stock market's gone down a little bit. And then at some point, it's all self-fulfilling and it trickles down. That's my point. We're at such a self-fulfilling, somewhat Ponzi scheme now that something's got to trigger it down lower. What are the key leading indicators? I'll watch gold, cryptocurrencies. On the year, here's my key thing I'll end with. On the year, the Bloomberg Galaxy Crypto Index is up about 7%. It trades 3 to 4 times the volatility of the S&P 500, has a very high correlation with the S&P 500, and it's up less than S&P 500 in the year that it's a bull market. That's a real bad sign for these highly volatile speculative digital assets that were born. And now I think they're going to be the first signs of things collapsing and going down. Well, not to say collapsing, but normal reversion of highly volatile, of a very expensive risk asset, more so than ever. So I just looked at recently just a 100-day correlation of Bitcoin to the S&P 500. I use the S&P 500, very similar to obviously NASDAQ, is about 0.56, almost 0.6. And the 100-day correlation of Bitcoin to gold is negative, almost 0.7. So it's a key thing I published for years, is Bitcoin digital gold or leverage beta. Well, sometimes it's more digital gold and sometimes it's more leverage beta. Right now, it's very much leverage beta. And I think that's the risk, that it's going to lead the way lower, maybe the crypto market much more than Bitcoin. Bitcoin's still the outlier, but that's the key problem. There's 19 million cryptocurrencies now, and every one of them has legitimate. I'm looking for the trial I'm looking for this space is very similar to what I was looking for. And I remember well with internet stocks in 2000. Once we wipe out some of the excesses, purge them, get them back to zero, or lose 90%, then we can reset. But we're nowhere near that, but maybe we're starting. And by the end of the year, we might have a clear indication. Obviously, I'm making my base case we'll be heading that way. This week is last month, July is very akin to July 2008, what happened with crude oil. I remember it vividly, got that trade right. Don't always get them right. This one, I think I'm going to get right in the long term. When crude oil peaked at $147 a barrel and the average gallon of the gasoline in this country jumped up to $4, that was a sign of the end of the beginning of the end, and then everything collapsed. Copper just did that. The metal med said they have a PhD in economics. Now, we all know why the U.S. price spike is because of tariffs. But tariffs are also part of the big picture. And then we found out we're not going to be tariffing refined copper, which we thought was silly in the first place. But now that it's collapsed back down to $4.40 from the high of $5.96, the highest ever. That high, $5.96, could last for a long time. I shouldn't say never, but that crude oil high at 2008 still stands. These kind of things usually happen in commodities. Once you spike on such high prices, you usually have very enduring hangovers. And typically when you spike like that, to get too expensive, you always have to find a too cheap level to find a trial. And I don't think we're anywhere near that. So I've heard another colleague today ask me if I should buy copper. And I said, well, good luck. I think it's had an uptrend line since 2020. That trend line comes in around $4.15. The key mean is around $4. I think it's going to break that trend line and goes lower. All the indications for copper technically that goes up, which means at some point there's just too many people leading that way and it goes back down. And to me, that's my counter consensus call. It's going to kind of lead the way. What are the guidance for that? Crude oil has already done it. Equally economic sensitive. Grains have already done it. Corn's in that space. What's happening in China? What's happening in iron ore? It's basically stuck below $100 a ton forever, and it's heading lower. And what's happening with 10-year note yields in China? So I'll end with this. Copper right now at $4.40 a pound You can overlay that with the U.S. 10-year note yield and just put them in the same. It's right now $4.24.2% yield. They're both, I think, heading towards 3. It just needs some kind of trigger. And the biggest trigger on the planet is the U.S. stock market, just giving back some of its extraordinary gains of the last few years, which is always the way it happens, is mean reversion. It feels horrible, but it's, if you look back from 5 or 10 years ago, people still had major gains, but it's usually not how humans look at things.